See my screen. Can you guys see my screen? Can you guys see my screen? Please, if you guys can see my screen, please you guys should respond. Please, let's start this class.
I can't see it, but it's not yet. It's not showing yet, but I can. Okay, I can see it now.
You can see it now.
Yeah.
I'm already
Yeah, I
sharing
can see it
my
now.
screen. I'm already sharing my screen. So we said we are going to talk about, we are going to jam 4 classes today. That's liquidity grab, and market structure, premium and discounts, and point of interest. So we'll first start with liquidity. What is liquidity? And first of all, what is liquidity? Liquidity are places where price might probably take out. These are like, I don't know, these are like points where price. You guys can hear me, right? Please. I don't know. I don't want to be talking to myself. Honora, you can hear me. Dorothy, you can hear me, right?
Yes, I can hear you, but sometimes mine is breaking. But
But what?
I say sometimes the line will be breaking. I can hear.
Yeah, I guess it's your network, but yeah. Okay, back to what we are saying. Liquidity are highs. Previous day high, previous day low, weekly day high, previous week high, sorry, previous week high, previous week low, previous month high, and previous month low, highs and lows. Liquidity simply means how where price is going to wait. Like in a simple man language, liquidity is just where price is going to wait at. Like those points are points whereby we see market is going to come back to those places and take them out because their liquidity is resting on that place. Their money, liquidity resting on those places. This is a high. There is liquidity. Price came back, took it. This liquidity. This liquidity is a high. Price came back. old highs, old lows. These are liquidities. This is a high. Price came back and took those highs. Liquidity, all these lows, highs, previous day highs, previous day. Let me go to 1 hour time frame and let's see it more clearly. Okay. These liquidity, 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 everything. Like if you go to this price is full of liquidities. So price that is liquidity that moves the market. Where is liquidity in the market? Because the market tends to move where the liquidity are in the market. The price tends to move where liquidity are in the market. Because it's liquidity that moves the market. If there's no money in this market, the price will not move. That's why the price needs liquidity to move. So it moves where there is liquidity. And liquidities are previous day high, previous day low, previous week high, previous week low, previous month high, previous month low, and highs and lows of the day. Not in the highs and lows of the day, it can be highs and lows. So you have to understand liquidity, because if you don't understand liquidity, you definitely need liquidity because when you might be putting your stop, might be where liquidity is resting, and price will definitely take out those liquidities. And after taking out liquidities, the next thing is reversal. And you'll be like, oh, price stopped me out and went to my direction. But you have to understand that this market is full of liquidity. Everything you are seeing here, everything here. But price to move from year to year shows that liquidity lies here. So the liquidity was pushing the market upward. Liquidity. For price to move from here, price will move from year to year. There is liquidity that pushed it down. This low, there is liquidity resting on this low. That was why price moved down here to take out this low. So you have to understand liquidity grab based on market structure. Because I told you guys we are going to be touching liquidity grab and market structure, premium and discount, and point of interest. Let me write it down. Liquidity. I told you we'll be touching liquidity grab, and market structure. Liquidity grab and premium and discounts. Premium and discounts. Then point of interest. I told you guys we'll be treating these topics today. So liquidity grab and market structure is more like combining this first one and the second one. So you have to understand that you should be looking at the liquidity based on the market structure. Let's use for example this. Let me remove all this. Sorry. Let me remove this. Let's say for example this structure now. From what I've taught you, you guys know that this thing is a downtrend. From year to year, the market was moving downward, even though that the overall trend was bullish. Even though that the overall trend was bullish, but from year to year, the market was moving downward. So as you can see, as the market was bullish in this, okay, it broke structure, it took out liquidity. And if you find out that every single time it takes out liquidity, you should be looking for a reversal, because most of the times it's reversed to probably a premium zone. Because if you take your Fibonacci from year to year, this is 50%. You see, it came down to that premium zone, this premium zone, and reversed, came down again, to premium zone, came back before it took this low. So price has to, and even if you decide to use this low as your Fibonacci stuff, you see that price came back to that discount zone. Because if price is in the premium zone, it means that price has been overbought. Price is overbought. So you shouldn't be looking for buy scenario in overbought scenario. If it comes to overbought scenario, also you should be looking at his sell scenario. So you have to understand market structure based on liquidity. Because, for example, let's just say it's clear that market was in an uptrend here. From year to year, market was in an uptrend. What was the nearest liquidity? Like, you might think that price might take out this high. This is an old high, and price took it out. What was the next thing you can think of price might take out? Boom. And if you can see, after taking out that old high, what did you see? Price reversed, came back, went up, take out this high again. After taking out the high again, what do you see? Price reversed. So you have to understand that what moves this market is liquidity. So you have to understand where is the liquidity lying in this market. Because before you trade anything, you have to understand where the liquidity is, or you'll be the liquidity. Where is liquidity lying on this market? Hope you guys are understanding what I'm saying, please. Okay, Chukudolati, are you guys understand? Do you guys have, at this point, do you guys have any question? Dolati?
No, I don't have any question.
No,
Okay,
I don't have any question.
Okay, thank you. So you have to understand. No problem. So you have to understand that for this market to move, there has to be liquidity that has to push this market, or else this market is not going to move. There should be a force, driving force that will move this market for it to move. And if you let's go to the higher time frame. Let me know if I can check it. But I don't want this class to be long, because I don't want this class to be long. Like, actually, it shouldn't be more than 1 hour, or in fact less than 30 minutes. We are done. If you check out this chart now, price took out this low. This is a double top. Everybody knows the liquidity. Price took out this low. Boom. Next thing was reversal. Price took out this high. Next thing was reversal. So you have to understand. And if it's reversing, price will have to come to a discount zone. If you see price refers to a discount, that's why I told you guys I'm going to teach you guys this topic. This is because they are intertwined, like all of them are together. Because price will definitely come to a discount zone. Then And as you're looking at it, that's why you'll be like, okay, fine, price has come to a discount zone. Where will be my next liquidity? This high. Because we're expecting price probably take out this high. If price doesn't take out this high, that means what will be the next liquidity? This low. And if obviously if price, oh, this thing now. If price doesn't take out this high, obviously you have to understand that obviously the trend of the market has changed. You have to know that the trend of the market has changed from uptrend to downtrend. Okay, it was even originally a downtrend. So okay, from uptrend to there, it was an uptrend to down. That means the trend of the market has changed. Because you're expecting this side. This is the nearest liquidity. Price has to take. This is the nearest liquidity. This high. This is the nearest liquidity. Okay, price has already come up to that place, but didn't take it out. Even though we are still expecting price to take out that high. And if price eventually didn't take out this high, then what we are expecting is probably price to take out this low. That's why you can't just enter because, oh, this is high, this is low. Price has to take out this high. You have to see a confirmation entry. Be like, okay, fine. Price is taking out this high. I have to be sure. You can't just enter based on, okay, fine. If it's like that, go to the lower time frame. You see that everywhere is liquidity. Because there are highs and lows in lower time frame. Even here, even check out this liquidity. This liquidity. This liquidity, 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 liquidity. In the lower time frame, because this is the higher time frame. You go to 15 minutes, 30 minutes, these are highs, lows that price might probably take out. So I feel like I've touched liquidity, I've touched liquidity graph and market structure, I've touched premium and discounts. Then point of interest, which is the last one. Point of interest are area in the market where we expect price to give us a certain reaction, either reversal or continuation. Either reversal or continuation. So you have to understand that price might probably, you have to understand that price, that point of interest, is either price give us a reaction or continuation. For example, this is a point of interest, this zone is a point of interest. From what I taught you guys, this is liquidity, this is a liquidity. But I don't, you guys shouldn't have, you guys should still remember, I told you guys about this pattern. And this is exactly the same thing that happened there. Price took out this low, broke structure, came back and started going. If you put this thing now here, you see that it's the same thing, nothing like the same thing that I taught you guys in supply and demand. This is it. Exactly the same thing, the same pattern. Exactly the same pattern. So these are area of interest that you expect price. Your different traders have their support and resistance trader has their own area of interest. They expect in a support line that price has to give us a certain reaction on the support line. A resistance line has but I'm teaching you guys supply and demand, because one thing you have to understand in this market is that whether you're using support and resistance though, whether you're using supply and demand though, all those things work depending on how you use them. All those things works depending on how you use them. So you have to understand, this is a demand zone. That your demand zone is already your point of interest. You are expecting price to give you a certain reaction on that zone to know if price is going to continue or the zone is going to hold or not. If the zone is if the zone is not holding, if the price doesn't give it certain reaction on that zone, then there's no point entering that zone because the probability of it not holding is there. If it gives you enter, that's a continuation. Mainly supply and demand are most likely continuation. That price is going to reverse to this zone and continue. Price reacted in this zone. So I'm expecting price to break this high because this zone has been obeyed already. And after taking out this liquidity now, I'm expecting price to come down to a premium zone and continue upward to this zone again because this zone is already a supply zone. This one is a supply zone because price took out this high, took out this low. Even though price is originally on uptrend, because it's possible that price might do this thing. It's possible. Price make all this low. Okay, do his thing, do his thing, do his thing, do his thing. Do his thing. Come back here and continue downward. Or price can come take out this low, still continue downward, or take out this low and continue upward. You don't know what price will do. That's why you have to see what the reaction it gives you at that zone. That makes it because your point of interest doesn't mean that price is going to obey it. It's your point of interest mean that you are expecting, you're anticipating that price is going to react on that zone. I don't know if you guys understand what I'm saying. Dorati, are you understanding what I'm saying? So I don't want this class to be long because other classes has been long. I don't know. If you guys have any questions, please, you guys should draw me back because I'm moving fast. I want this class to be short. I don't want it to be long like the previous classes. I want it to be short. If you have any confusion or any question, please don't just draw me back so I can explain or anything you find confusing. So far, so are you guys good with what I've explained? Dorati?
Yes, I'm understanding.
Honora?
Understanding is.
Are you guys good with what I've explained so far?
Yes, I'm good to read, but I'm good to read. I've understood it.
Yeah, I can't hear you. Can you speak up, please? Honora, please speak up.
I say I have no question. I understand it.
You understand, Neba?
Yes.
Okay, no problem. Dorati, same with you, right? Okay. And then since you guys don't have any other questions, I think we are done for today's class. We have touched liquidity and market structure. We have touched premium and discounts, and we have touched point of interest. So I told you the liquidity are previous day high, previous day low, previous weekly high, previous weekly low, previous monthly high, and previous monthly low. The highs and lows of the market. This is the liquidity. The liquidity graph and market structure. Like I said, you have to be looking at liquidity based on the structure of the market. If the market is downtrend, that means what the liquidity you are expecting market to take out are lows. If market is in downtrend, the liquidity you are expecting market to take out are lows, previous day low, previous lows, previous low, previous day low, previous weekly low, all these kind of things. Or low, if it's an uptrend, you're expecting market to take out highs, previous day highs of the day, and highs in the market. then you have to understand that once price take out those highs or take out those liquidity, the next thing is to return because price is already overbought or oversold at that point. So the next thing is to return to a premium or discount zone for continuation. And within that premium or discount zone is where you're going to mark out your point of interest. Because that's where price is going to come and reverse. Because any point of interest you're marking should be in a discount or premium zone. It should be in a discount zone if you are buying and a premium zone if you are selling. You have to understand. That's why I said I'm going to teach all these 4 topics together because they are like brothers and sisters. They are because they go hand in hand. So if you don't have any other question, I think we are done for today's class. And yeah, on tomorrow, our next class will be tomorrow, which is confirmation entry. I guess our next class is tomorrow, same time, 9 p.m. If anybody have question, should just throw the question and just go to the chart, mark out highs and low, and you find out that price took out those low based on that structure. All these things I've been teaching you guys, structure, market structure, our liquidity, supply and demand. You have to put all of them together. Anyways, I'm still going to teach you guys at putting everything together to form a bias in the market. But for now, you have to understand what is liquidity, what is liquidity grab based on market structure. So I don't know if you guys don't have any other question, then I guess this is the end of the class. And I recorded this class, so in case you want to come and rewatch it, and those that are not in this class will be able to rewatch it. If not, I guess you are done for today's class. Please, if you have question, please do well to ask. Then if I end this call and you probably later have a question, you can probably type it in group. Then if I see it, and I'll reply you guys. But for now, I don't think I have a question or I have anything else to say on this topic again. So are you guys good to go? I said the class will not be more than 30 minutes. It's already 28 minutes. Are you guys good to go? Yeah, since anybody's not talking, then I'm going to get some. Yeah?
Yes, boss.
You are good to go?
Yeah, we are good to go.
Okay, fine. Then that means I'll be ending.
Yes, boss.
Eh?
For now.
Okay, for now, you guys are good. Okay. So that means I'll be ending this class. And if you guys have another question, you guys should just come ask me in the group and I will reply you guys.